This is not financial nor professional advice. This video is for entertainment only. Hey everyone, I'm Stephen Fox. Welcome to my channel. Well, we got the big numbers from the CPI report and it looked good. I mean, inflation is going down, but yet the stock market went down. We all thought it would be screaming upwards. Whatever happened? The consumer price index rose only 5% year on year, and it rose only 0.1% month on month. Those are excellent. They came in far below what was expected. Why didn't the market immediately shoot up? I'm getting so I wait for the market to digest these numbers, because I think first impression is not the best impression. The market digests these numbers and they look more closely at them, and what they're looking at is the core inflation. Now, the core inflation excludes energy and food, just the things you actually need to live. But the reason they do that is because those costs are more variable. And the sticky inflation is things like housing. And that housing went up and is running at about 8% per year. Energy costs actually declined. Used vehicle prices actually declined, and food prices were more or less flat. So that there was good news in this, but the core inflation, excluding energy and food, going up 5.4%. Now it's actually higher than the total inflation. And then month on month, it went up 0.4%. The Fed is not going to be impressed with this. They're going to be impressed that they're going to need to raise it a quarter point. And it seems like that's all the market cares about, is whether the Fed's going to raise rates. So stocks went down, even though it was a good overall inflation number, because they were more worried about the sticky inflation. It's come down from about 9%. Now we're in the fives, but the core inflation is at 5.4% versus 5% on the whole number. So we're to the hard part, and it looks like there's factors that might make that hard part even harder. Wall Street is treating this dramatic reduction in inflation in this CPI number as a one-off event, that it's unlikely to be maintained and going forward, and that's because of energy costs. A big part of the drop was in energy coming down in March, but now the price has come up somewhat, and OPEC says they're cutting production by 1 million barrels of oil per day. And Russia says they already cut their production by 700,000 barrels of oil per day. So it's slated that your energy costs are going to go up, and they were a big part of this dramatic reduction we saw. And I think Wall Street is seeing this and saying, yeah, this is variable. This is a one-off event. We just got the business put to us by OPEC and by Russia again. When you look at this chart, you can see why Wall Street is skeptical about the numbers reported, because the only thing that's down over the last 12 months is energy. And yes, that is going to change because Russia and OPEC have announced their production cuts. So the price of oil has already gone up somewhat, and barring major increases from other producers, we're going to be paying more for gas probably, which is going to ruin the inflation numbers overall, which is going to cause the Fed to keep raising rates. So I think it's too soon to speculate that the Fed is anywhere near decreasing rates. They are not going to cut rates. They are trying to reach a level and then hold. They're going to raise it a quarter point this time. And I think after the next CPI report, they're liable to raise it another quarter of a point. And I think there's possible investments such as bonds that you can buy to be safe. But I'm putting my money into money markets and waiting on the bonds simply because I want to be to the point where I'm more or less sure that the Fed is done raising rates. One thing that's likely to keep getting cheaper is electric vehicles. Tesla has decreased their prices like 5 times so far from the height of when they raised the prices. Musk more or less played the market like a fiddle. He kept raising the prices when demand was strong, and now he's able to cut prices simply because he raised them so much before, but also because lithium has come down in price, and also his manufacturing process is so efficient, and they keep reducing costs, and they have the highest margins. Everybody else making electric vehicles, they lose money when they sell an electric car because they don't have a good enough margin on it. They haven't been efficient enough in their process of how they're creating their electric vehicle. Other car companies are still making most of their money on gas vehicles. Musk has such margin on his cars that he can continue to keep cutting his margin, and he's doing that to grab market share, and he's going to force some of these companies out of business as he collects more and more market share. The IRA Act, that's the Inflation Reduction Act, increased electric vehicle adoption, and it's projected that about 50% of the cars bought by 2030 will probably be electric vehicles. And they think that the Inflation Reduction Act increased that amount by about somewhere between 8 and 10% because of the tax breaks you get for buying an electric car. As can be seen from this chart, there's about a 70% chance that they're going to raise another quarter of a point on May 3rd. So the question is turning more to, are they going to raise it again in the June meeting? But of course, we will have to wait for another CPI number to see if that nightmare becomes true. But I think for me, the best thing to do right now is to hang out mostly in money markets. I want to have access to the cash in case the market does turn. And I think I don't want to buy bonds yet until they're done raising rates, because when they start to cut rates, or maybe even if they give a solid pause, bonds will usually go up in value. And I don't want to buy them before they're going to keep increasing rates, because your bond goes down in value. Now, you still get the same interest rate if you hold it to maturity, but the money markets in the short term will beat the bond if you buy it too early, because the money market interest rate will go up. So short term, I'm in money market funds with a few selected stocks that I'm going to share with you now. I've been very strict about the criteria about which stocks I'll buy, and I'm buying these as long-term holds. I'm not putting a major amount of money in them, but I want to buy some because I don't want to look back and say, well, I missed the opportunity to buy these when they were cheap. My favorite stock that I keep pounding the table on is Super Microcomputer. The SMCI is its symbol, and it happens to be a technology stock that Warren Buffett of Berkshire Hathaway owns. So that's encouragement. Looking at the chart, it's well above its 50-day moving average, and it has a relative strength of 55, so it's not overbought by any means, nor oversold. And it has a nice upward slope going up since the beginning of the year, and that's pretty much been its history as far as I'm concerned, as far as I've been covering the stock. So it continues to be a winner, and I think it'll continue to win. Right now, given this atmosphere, I'm only buying stocks that are significantly undervalued. And it's trading for around 108, and its value is thought to be about 147. So I think we're in good stead going with this company. I've also bought shares of ST Microelectronics, and this is a company that was formed by a combination of an Italian microelectronics company and a French microelectronics company back in 1987. They're known mainly for making chips for automotive and industrial purposes, and they have an excellent chart. Looking at the chart of STM, its year-to-date chart, it's above its 50-day moving average, and its relative strength is 49, which is right in the middle. It's neither overbought nor oversold, and it's underpriced because its full value is thought to be about 68, and it's only trading at about 49. And with a price to earnings of about 11 for a semiconductor company, this is excellent. So I think this is one that I'm buying a certain amount and putting it away for the long term. I also wanted to buy a mega cap that wasn't too overly valued, and I decided on Google because its forward price to earnings is about 19. But I was especially affected by the news that they're producing, they created a chip that is actually thought to be better than NVIDIA's, which is amazing. Looking at Google's chart, it's well above its 50-day average, and it has a relative strength of about 58, which indicates it's neither overbought nor oversold, and it looks like it's climbing out from its lows. So this is something I like the news on it. I've always liked the stock, and I plan to hold it long term. I also bought some NUGT, which is a triple leveraged bullish fund on gold miners, and it's done very well so far. And I think Russia and China and other countries are buying gold to strengthen their currencies, and I think that's one of the main factors. And the dollar's been going down somewhat lately, and that also seems to be helping the price of gold, and of course then helps the gold miners. So we will see where we go with that one, but it's a swing trade that I watch closely, and it's risky. It's not your average investment, but I think for me, it's something that I've watched long term, and gold has finally gone above $2,000, and so I think this is something I can make money on in a couple of months, which is probably about the length of time I'll hold it. Looking at the 1-year chart on the NUGT, which is the triple leverage bullish fund on gold miners, you can see that it's had a rough year, especially a year ago. It came down significantly in price, and it looks like it's climbing out of the hole it was in, and it's because the price of gold has gone above $2,000, and I think the prospects look relatively good for the price of gold. And so I'm going to swing trade this and see if I can make some money with this triple leveraged fund. Smash the like button if any of this has been helpful. I'm going to keep trying to ferret out what investments might be worth holding for the long term. I don't see shorting as working that well on the market in general, just because it's such an up and down and upside down market, and it should have exploded upward today, and it did not, which is isn't that just like the stock market? It never does exactly what you think it will do. All we can do is follow the probabilities and hope for the best. And I think I'm buying some solid things for the long term and waiting for things to turn around. This market is very difficult to trade. It is a bear market, or it's a market that wants to go forward, but is constantly being held back by the Fed. And so it's actually the Federal Reserve's market right now, which hopefully this too shall pass, as they say. Thanks for listening and watching. I hope to see you in the next one. Thank you.